Welcome to In Conversation with DLC's Chief Economist, Dr. Sherry Cooper. Today's edition is brought to you by Bridgewater Bank. I'm your host, Eddy Cocciollo, President of Dominion Lending Centers, Inc. Dominion Lending is made up of over 4,000 mortgage professionals right across the country with access to Canada's best mortgage rates. Whether you're buying your first home, refinancing, self-employed, moving on up, or downsizing, with access to hundreds of financing options, we can find the right fit for you. If you're not using a Dominion Lending Center's mortgage expert, for your home financing needs, you're probably paying too much. Visit dominionlending.ca today and find a mortgage expert near you. Allow us to be your trusted advisor when it comes to managing your debt. Dr. Sherry Cooper is celebrating her 7th year with Dominion Lending Center as our chief economist. She is a sought-after speaker, writer, and advisor renowned for her abilities to simplify and demystify the complex subjects of economics and finance. Sherry helps Canadians understand the issues surrounding their most important financial decision, buying a home. Also on dominionlending.ca, click on Economic Insights for Sherry's very insightful articles on the latest economic trends. All right, Sherry. So you are you're batting 1,000 this year as I'm predicting what rates will end up from the BOC. You predicted last time that it would be up a quarter. The time before that, there wouldn't be any change. And this time, 50 basis points, which has come true. So lots of questions for you, Sherry. I'm sure. Just to remind everyone, today's broadcast, we're going to take questions at the end of Sherry's presentation. So she's going to go through about 35 slides, about 30 to 35 minutes, and then we're going to get to all the questions. So if you have questions, send them in. Dave, our executive producer, will put them in order and we'll ask Sherry right at the end. Okay, Sherry, where do you want to start?
Well, Eddy, I think we got to talk about what's going on in the world and then zone in on what the Bank of Canada did today and what does that mean for all of us.
Sounds good. Let's go.
Okay, so here we are. Now, not only do we have inflation that was the result largely at first of a surge in demand following all the lockdowns with COVID, and then more recently, the Ukrainian war. And the war in Ukraine is a huge, huge disruptor, aside from the fact that we are seeing such devastation in that poor country with so many people being killed and brutalized. But aside from that, just from the sheer economics of it, it's disrupted supply chains even further. It's led to big increases in some commodity prices and slowed economic activity. And of course, without question, it has led to a significant degree of risk and uncertainty in the world. And it's certainly not over yet. What we're seeing is, as a result initially of COVID and then more recently as a result of the war, is globalization is stalling, and in fact, in some cases, even going into reverse. Trade has fallen, prices are surging, economic activity has slowed from what it would otherwise be. This shortening supply chains, businesses are trying to reshore jobs, and it's becoming more and more urgent. Not only that, but we see that many countries are trying to quickly shift from reliance on energy and metals and fertilizer and food coming from Russia and Ukraine to other parts of the world. Canada has actually been relatively less impacted by all of this economic threat because we are commodity producing country, and that does benefit our economy. But in general, what the Ukraine war is doing is boosting the inflation numbers around the world, and then as well slowing economic activity from what it would otherwise have been. Now, certainly the impacts are greatest in Russia, in Ukraine, in Eastern Europe, and then in Western Europe. Less of the impacts directly to North America, but of course we can't help but be affected because of global food shortages and tremendous increases in some commodity prices. Now, as we go into this year, all of this uncertainty made it very unclear what to expect. Right now, it looks like the growth pace in the first quarter of this year will be around 4%, which is very strong. But we've revised down our forecast for the remainder of the year, growth more in the 2 to 3% range. When you look at Canada overall, for 2021, we saw very strong growth of 4.6%, but in next year and the year after, it's likely economic activity will slow. Now, this looks at real GDP growth. The question becomes as well, what does this mean for inflation? And of course, that's where we've had big increases in inflation as a direct result of the Ukrainian geopolitical uncertainty. Now, Canada's economy has returned to the pre-pandemic growth strength. And in fact, the Bank of Canada said today that now there's actually excess demand in Canada, meaning that what we are seeing in Canada is that inflation is coming not just from the disruptions on the supply side, but from strong demand, even domestically. Higher inflation, higher interest rates, and war dampened consumer sentiment has certainly impacted Canadians. This is the Bank of Canada's survey results. The most recent survey conducted about a week and a half ago, it shows you that Canadian household sentiment has declined largely as a result of the big uptick in inflation. Our jobs market, however, is running red hot. We are at full employment. In fact, we are beyond full employment. There's excess demand, labor shortages in Canada. Now, this chart shows you that the jobs rise in March was just, continuing to be very, very strong. We are now at a level of job creation that's well above what we saw before the pandemic began. The other thing that's really quite remarkable is the unemployment rate. When we were in the midst of the pre-pandemic period, the unemployment rate was at a record low. Eddy, I got to tell you, there's a guy outside the window cleaning my windows.
That's awesome. This is live television, Sherry.
Really?
That's what you get.
I know. It's like I'm thinking to myself, like, who's on my balcony?
That's awesome. That is good. Well, maybe he needs a lesson in economics. Maybe he's paying attention. Who knows?
Yeah, really. Okay. Back to my slides. 5.3% unemployment, lowest unemployment rate in the history of this data series, which began in 1976. In the pre-pandemic period, the unemployment rate before, like in February of 2020, was at 5.7%. So we have really got ourselves one tight labor market. And as a result, as you'd expect, wage inflation is rising. So wage rates are going up on a year-over-year basis of 3.7%, which is below the level of inflation. But certainly it's becoming more and more embedded in the economy because we still have almost 1 million job vacancies. And help wanted signs everywhere in every sector. So inflation. Now, it wasn't bad enough when the disruptions were just coming from COVID, but now we've got oil prices, metals prices, wheat, corn, fertilizer, all soaring as a result of the massive disruption and destruction in Ukraine and also the sanctions on Russia. So supply disruptions only getting worse with shortages in so many different areas. And what's of great concern to the central banks around the world is that if this inflation carries on for too long, they become embedded in the economy through the expectation that inflation will remain, which leads to higher demands for increases in wages. And also it's impacted by home prices and rent inflation, which has been a major fundamental in Canada. So let's look at those inflation numbers. Well, the US inflation and the March data were just released 2 days ago. It's now at a whopping 8.5%. Just that's the consumer price index. Just this morning, the producer price index was released, and for March, that was 11.7% inflation. That would be the prices that are the prices that go into the production processes. Those are so impacted, of course, by commodity prices. Now, for us, the February number in the US, in Canada, was only 5.7%, but we'll get the March data in 1 week's time. And I certainly would bet, and the Bank of Canada is betting, that that number will be over 6%. They actually said that in the monetary policy report that was released today. So upward pressure on inflation. Inflation in Canada is broadly based, and as well, the shelter costs have increased sharply. So this is the imputed value that Stats Canada estimates for the cost of owning a home. And given that home prices have been rising so dramatically, this is why that number has gone up. And as well, it also includes rental accommodation, and rents have gone up dramatically as well. So what does all this mean for monetary policy? Well, we saw that. This morning, the Bank of Canada announced a full 50 basis point hike in the overnight rate. The overnight rate is their policy target. By raising that overnight rate, that leads to an uptick in a commensurate uptick in the prime rate. So the prime rate, which was at 2.7%, is going to go up by 50 basis points. And then the also very important is that they have told us that more interest rate hikes are coming. And as well, that beginning on the 25th of this month, they will no longer reinvest the money that they receive from their balance sheet holdings of federal government debt. Instead, they will let maturing bonds run off, which means they're reducing the money supply by the amount of maturing bonds. So over time, that puts upward pressure on the longer term maturities. So they directly impact the overnight rate, and then through market forces, they impact 2 years and out. And it already has had substantial upward impact on mortgage rates because bond yields have risen in anticipation of this 50 basis point tightening. So there we see the big decline in overnight rates prior to, just as we were entering the pandemic crisis, and now the unwind of that easing in monetary policy. Now, looking at the swaps market, traders are betting that we will see a rate hike every time the Bank of Canada meets for at least the next 4 quarters. And so markets are pricing in 6 rate hikes in the next year, which would take the overnight rate to at or near 3%. It was at 1.75% before COVID hit in early March of 2020. So interest rates are still low by historical standards, but from a percentage point increase, they are going up very dramatically. And here I show you what's happened to the 5-year bond yield, which is tied more closely to the 5-year fixed mortgage rate. When the bank met on March 2nd, that was the day they first hiked interest rates, the overnight rate, by 25 basis points. The 5-year yield was at 1.56%. And you see that as of today, right before we began this webinar, the 5-year yield was up 61% in just over a month's time to 2.5%. So these are very, very large percentage increases in interest rates. So that's already led to upward pressure on mortgage rates to call it 3.5% to 4% for fixed rate loans. Now, what the Bank of Canada is hoping for is a soft landing. What they want to see, of course, is that they get inflation under control back down to their 2% target rate without throwing the economy into a recession. So I'm sure you've heard the number of economists that are suggesting that a recession is very likely. Now, a slowdown doesn't have to mean a recession in theory. Mm-hmm. And so, we too are hoping that the Bank of Canada can pull this off. But of course, so much of what's causing inflation is not under the control of the Bank of Canada or any other central bank for that matter. And so there is a good deal continued worry and continued uncertainty about the outlook. So what has that meant and what does it mean for the Canadian housing market? Well, the housing data are not going to be released for the month of March nationwide until Tuesday of next week. It's been delayed because of the Easter holiday, but I just wanted to show you a comparison here. These are the top 10 cities with the least affordable housing. And now Vancouver's been way up there. It's number 3 in the world. And Toronto is number 10 in the world. But what I wanted to show you is that home prices have already begun falling in Hong Kong and in Sydney, the number 1 and number 2 most expensive markets in the world, while values in Singapore barely rose last quarter, as buyers are wary of rising interest rates and the economic headwinds many buyers, or at least at the margin, many buyers have moved to the sidelines. So that portends, of course, that we'll see something similar in Canada. Now, the early signs of a housing slowdown are now already showing up anecdotally, not everywhere, but in some key places. Across Canada, we have seen a big increase in new listings. So inventory is nowhere near as tight as it was just a month ago. In the GTA and the Greater Golden Horseshoe, anecdotally, we have evidence of fewer multiple bidding situations, and there are softer price gains in most of the markets that have already reported. But still, aside from some pockets in the GTA, prices are not falling, but they are increasing by significantly less than the 40% increases, 30 to 40% increases that we saw over the past 18 months. Mm-hmm. So, and you would expect that sales will slow further, especially once the pool of buyers with 90-day rate holds is exhausted, because mortgage rates have increased significantly just in the last month. And we have mortgage approvals at rates up to 100 basis points below current levels right now in the pipeline still. And these people, of course, are highly motivated buyers. And with more supply in the market, I would expect that sales will certainly continue until this is worked through, and then we will see an impact on sales. I mean, higher interest rates will remove some buyers from the housing market, and particularly given that 5.25% rate at which everyone had to qualify in the stress test for mortgages has now become not just the maximum of the stress test, but it's now going to be 200 basis points above the offered mortgage rate that you have to qualify for. And with mortgage rates at something like 3.5% to 4%, that means that the 200 basis points above that becomes the binding qualifying rate. We also know that home building has not kept up with new household formation. So, and in the budget, the government is taking actions to stimulate housing construction, but also to help the first-time home buyer. Part of the reason that there's such a shortage of homes is because of the big increase in immigration. And I'm just showing you here that right now the plan is for this year that we see a stepped up figure for immigration of just over 430,000, rising to 450,000-ish in 2023 and 2024. Question is, can they build quickly enough? I mean, with our very strong population growth, 5.2% population growth rates from 2016 to 2021, it's not surprising that we have substantial and growing housing shortages. Now, the budget did two things to address the situation of housing affordability. For first-time home buyers, they introduced some initiatives. One was the tax-free home savings account, which is certainly a positive development and one that all young families should be taking advantage of, because you can deduct whatever you put into that account from your income the way you would what you contribute to your retirement savings. But even better still than a retirement account, you can take that money out and never pay taxes on the income you have saved there. So you can grow your savings tax-free that way. But of course, it takes several years, if not many years, for most people to save up a down payment. So that's not going to have an immediate impact. But the other thing is that they've doubled the first-time home buyers tax credit and extended the first-time home buyer incentive. But the federal government, along with all other levels of government, have taken initiatives to speed up home construction. Municipalities have ramped up building permit issuance. The building has accelerated. It's just we need to see even speedier approvals, and incentives are being put in place to speed up the approval process, rethink zoning, and allow medium density development in low density areas. So Eddy, that completes my formal presentation. And so I would like then to open it up for questions or comments.
Yeah, thanks, Sherry. That was really good. I do have a couple of comments. One is as you saw Sherry go through those slides, and rising rate environments sometimes can be a little daunting or scary. So the first thing I would say to those that are maybe in variable rate mortgages, don't panic and think that you have to lock in. I would strongly suggest that you talk to a mortgage professional before making such a move. So you can go to dominionlending.ca, find one of our mortgage professionals, and they can walk you through strategies and scenarios that will help you understand where you should be in terms of either locking in or continuing with a variable rate. In saying that as well, Sherry alluded to some pre-approvals out there. If you do have a pre-approval and you are looking to purchase, that may be speeding up your decision making quickly. And for those that are waiting on the sidelines to buy, timing the market is very difficult. We're not saying that prices are going to go up or down, but as Sherry alluded to, certain markets it could very well go up, and then there's some markets that will go down. So just have that conversation with your mortgage professional, have that conversation with your realtor. Don't panic, and hopefully things will work out for you. Sherry, there's some questions here. We'll get to the questions. If you have questions, send them in. We have a few. We're going to try to get through all of them. The first question is from Tom Parent, and Tom is asking about will rates resolve to pre-pandemic levels or worse? So I guess Tom is alluding to that before the pandemic, they were about the same or a little bit less than they are now. And emergency rates needed during the pandemic. So the government responded, and now we're seeing some rates go back to pre-pandemic levels. What are your thoughts around that?
No, unfortunately, I think that mortgage rates are going to be above those levels prior to the pandemic for at least the next 2 years. And likely, you see, the Bank of Canada now is forecasting a return to 2% inflation in 2024. And so between now and then, that would imply that they need to slow the economy. And the only way to slow the economy, as far as the bank is concerned, is to raise interest rates. And so interest rates will first they'll return to the bank's estimate of neutral, which the bank is now estimating that to be between 2 and 3%. And then they'll hike a bit further than neutral, and that's for an overnight rate. So what does that imply for mortgage rates? Well, as like everything else, it depends. If the thing to watch is the labor markets. There's no way to slow the economy without raising the unemployment rate.
Mm.
And so will we see that? When will we see that? You only want it to be gradual because you don't want to throw the economy into recession. And the answer truly is no one knows what the timing of all this will be because of all the uncertainty in the world. Not to mention that COVID, we're in a 6th wave now. And it seems like everybody I know is getting COVID. So it hasn't disappeared either.
Yeah. Sherry, so a little confused because you've mentioned that rising rates or trying to tamper inflation is very difficult to do it domestically because it's a global problem. So here we are saying, hey, you know what, we're going to try, and we've raised rates. What if inflation just keeps rising and rates just keep rising and there's no effect on inflation? What happens then? Because you're right, unemployment's going to happen because as rates rise, businesses are going to, have less capital because they can't borrow as much, et cetera, et cetera. So you're right. So that's going to happen. But what if it doesn't? I'm just saying that as a curious question.
Well, Eddy, I was at the Fed when Paul Volcker began to hike interest rates. Now, remember, U.S. inflation at that time and Canadian inflation was way above current levels. But so were interest rates. And we were surprised at how long it took and how high rates had to go to break the back of inflation. This is another situation altogether. It's a very different situation. And remember, it wasn't long ago when inflation was well below 2% everywhere. And I believe that we can return to that with far less pain and suffering than what we saw back in the late 70s, early 80s. But for sure, there's a great deal of uncertainty because we're dealing with two outsized exogenous forces, the disruption from COVID. And remember, in China, Shanghai is in a complete lockdown. People aren't allowed to leave their apartments. And think how disrupted that is. The Shanghai port is a huge component of, part of the whole supply chain. And there's no production. There's nobody, transporting goods from China these days, at least from southern China. So that disruption and then the war. And I'm certainly not able to really say that I have a set view on how long it's going to take for things to normalize.
Yeah, this one's going to be interesting and tough all around. There's a question up there, Dave. Just bring it back up since you had it there. I just want to make sure Sherry did answer it for Chris. COVID lockdowns in China and supply side impact on inflation. Yeah, of course, right? That's a given. And I wonder if Canada will increase its production on certain materials and commodities within Canada to help deflect some of that global inflation. Is that which will create more jobs and that's possible.
Well, there's in the budget, and it didn't get much attention, were these very substantial tax credits for exploration for minerals and metals that are essential for electric car development. And everything from nickel, of course, which we know there's substantial amounts of nickel in Canada, and they're going to be exploring and offering tax credits for those who invest in exploration for other, rare earth minerals and others. So that is a part. Oil, you would think that we could be out there providing an offset to Russian oil and natural gas, but we just don't have the infrastructure for it. And not only that, but the government has put limits on oil production, and the businesses, the oil companies, don't want to increase production.
Yeah.
So the other same thing with fertilizer. I mean, fertilizer uses an enormous amount of energy. For production, and yet there's excess demand. Food, same thing, excess demand all over the world. Canada is rich in all of these things, and we could or should be able to benefit not just from the price increases, but from higher exports. But it takes time for that to be stepped up, and it's not even clear that the incentives are right for it.
Okay. John Prada, my friend John Prada, has a question around domestic inflation risks. Inflation remaining increases still or decreases if Ukraine war stabilizes. So do you see if that, and man, that seems like that war is going to be long. I don't know. It's, I don't see a quick or swift end to it, but if it does end, will that help?
Not right away, because look at the destruction in Ukraine, and Ukraine has been the breadbasket for so many parts of the world. That isn't going to come back on stream very quickly. If the war ends because Russia is successful in capturing the eastern part of the country, the sanctions aren't going to come off Russia. No. So that isn't going to be helpful.
No.
So even and if the war ends because Ukraine wins, that's the best result. But that also, I mean, you can't rebuild it that quickly. But there would be a Marshall Plan, I would think, coming from the certainly from the West, to step up the rebuild as quickly as possible. But I'm with you that I would think this thing's going to drag on, and maybe drag on is the best result, because otherwise it's because Russia is able to take extreme measures and,
Yeah, I do. Asim, I just want to make sure we answer your question. He was asking about the overnight lending rates in the later part of 2023, 2024. The mandate of the Bank of Canada is to get to that 2%. So if it's there, then I would imagine, rates are going to come down. So would you agree? So if it goes from 5-6% down to 2%, you'll see rates come down.
Oh, yes. But I mean, I'm not sure that's going to be in 2023. I think it's more of a 2024 phenomenon, and maybe not even then.
Yeah, and then that's good for your variable rate clients, right? So if you are looking to lock in, if you have a great rate, then of course you'll be advised accordingly. But if you're worried about a 4% rate, variable is very attractive. So have that conversation with your mortgage professional and make sure that you're comfortable with a variable rate versus a fixed. Kendra Payet just says, thanks, Sherry. Thanks, Kendra. John, just another question from John. He talks about price stabilizing slowly right now, possible appraisal discrepancies not meeting purchase price. Do we see rates stabilizing, maybe reverting back to 3.5%? Yeah, appraisals is an interesting one, John, for sure. Obviously, when you go so quickly from a rate environment, and Sherry had one of the slides, just last time they announced it was at the bond rate is 1.5, now it's 2.5. That's a quick jump of 1%. Then, you know, housing in some areas may be affected pretty quickly. And will they appraise from when they bought them a month ago till now? That's a great question. I don't know the answer to that. Yeah. Anything to add there, Sherry?
Well, there are lags on both sides of that.
Sure.
I mean, it takes a while for the appraisers to raise the values, but the fact of it is that every house is an individual unit. Like you know what your house is worth when you have a buyer that will pay a price. That you can't believe that just because my neighbor got this or that that's what you'll get. And psychology is shifted. There's more supply, and I think individuals now don't feel pressure to bid against 20 other people to lock in the home of their dreams. And the whole fact that we've seen new listings surge tells you that sellers now are realizing that maybe they should have gone to market a little sooner, because it's going to be slimmer pickings than what they thought. So negotiations, I think, will be more balanced than what we've seen in the past.
That makes sense. What do you see happening with the benchmark rate? So I think we talked a little bit about that. That's from Brandy. You know, it's going to be rising for a little bit until that inflation somehow gets busted. Would you agree to that?
Yeah.
Yeah. Is Airbnb short-term rental inventory not having an absolute impact on housing availability in major urban centers? There's that argument for sure.
Yeah.
What do you think?
Yes, and I don't understand why the government didn't or hasn't mentioned it. And I also don't understand why the federal government isn't building dormitories at universities all over the country so that kids can get out of the housing market and into the dorms, and that opens up housing supply and generally lower cost housing supply for many, many families.
Yeah.
And the feds can do that. I mean, they can give the money to the universities to build.
You know, it's funny. After the war, they built what they call wartime homes, which are basic. They made it as basic can be, just so people had a roof over their head, right? And obviously very affordable. Why can't we have a mandate that comes out with builders that say, hey, we want you to do price ranges within this box. However you do it, all it's got to do is be safe. It's got to be warm in the winter and et cetera. But we want nothing fancy. I'm sure they can figure that out. But who am I? I'm just.
But nobody wants it in their neighborhood.
Yeah, of course. Jason Nugent.
Canada has a shortage of land, of course.
Yeah, of course. Jason Nugent, can we anticipate when the official qualifying rate will increase? What do you think?
Well, I don't think they need to increase it. They'll just do it at 200 basis points above the contract rate. Because see, it was the maximum of either 5.25% or 200 basis points above the offered rate.
Right.
So they don't have to raise the rate because it's not the minimum of.
Bernie Budney from beautiful Alberta. Dr. Cooper, do you feel the odds? What do you feel the odds are that we will see a soft landing versus a recession? Now, you're not saying a recession. I know we've had this conversation. So you're more on the soft landing side.
Right. I am. And I mean, everyone worldwide is hoping for that. And it's not impossible. I'm certainly not telling you that another 25 basis point rate hike is going to land us into recession. It isn't. And there's still a whole lot of pent up demand. I mean, still, people want to travel. They want to buy things that they haven't bought in a while, or they want to do things that they haven't been able to do. And there's still a good deal of positive energy going on, and so it's not. I don't think we're at a tipping point that one more rate hike and it's done. I don't.
Mhm. Yeah. And you know what's interesting is if prices did go down 30%, it would still be within the pandemic levels. Like remember, house prices doubled since Trudeau government came into power 2017, right? So, that there's and I'm not saying, we wish that or anything of that nature. I'm just saying a soft landing could be even, a big percentage of decrease and still be ingestible, if that makes sense.
Yeah, I mean, look, it's I never pay attention to what other people tell me about what my real estate is worth, because it's only worth whatever I could get for it if I truly were showing it. And so, if homeowners had this inflated view of what their property was worth, I think they're going to get a serious wake up call.
Yeah, exactly. I mean, your property's worth whatever someone's willing to pay for it at the end of the day. And if you're buying your forever home, buy it. It's your forever.
Yeah.
If you can afford it, if it's within the confines of you qualifying and your professional mortgage professional can help you do that, buy it. Go for it. If it's your forever home. Now, if you're an investor, you have risks. You're an investor. When you invest, you take risks no matter what you buy. So there's that part of it too. So, at the end of the day, I think we have a very strong economy. We live in one of the greatest countries in the world. Jobs, et cetera, et cetera, et cetera. Just in my mind is incredible, and you should make an informed decision, but don't be afraid of buying because you think interest rates are rising or prices are going down or up. Buy because you're looking for a place to live. We got a lot of questions here, and we got about 10 minutes left. So John Parada came back with a chapter of a book here. Having clients with a variable rate prime -1 puts clients at 2.2. But at 5 year, it's 4.09. It is better to have 2% paid towards principal, even if the bank prime rate goes back to 3.95, an increase of another 0.75 to the 3.2 to have today. So prime -1 would be 295, still lower than the 5 year risk. Yes. And that's just it. There is prime minus still exists out there. By the time variable rates get to the fixed rates, as John alluded to, of the 4% range, you have all that savings. Again, there are strategies. There is ways of looking at your situation, and sometimes it's all about you. So talk to your mortgage professional, talk to your DLC agent or broker, and they can have that sort of scenario, as John put it, in front of you so you can make that informed decision. Marie France. Hey, Marie, how are you? Do you think GVT will rethink the stress test qualifying rate today, now at 5.25? We talked about that. We don't think it's going to change. Okay, Phil Weir, will we see the U.S. and Canada ramp up manufacturing to offset the future reliance on China and Russia, especially chips? I mean, that's a long process. You mentioned that. Very long process. By the time that Canada can get to a situation where they can, replace whatever they're importing from other countries, correct?
Well, Joe Biden in his State of the Union address did not emphasize the global warming initiatives. He emphasized letting all this oil onto the market from the Strategic Petroleum Reserve and for stepping up production. So, this is such a political issue now, and no doubt there'll be a lot of talk about it. But the fact of the matter is, opposition parties love to blame inflation on the incumbent party.
Of course.
But I mean, especially in this case, it's hard to blame anybody on COVID or the war other than Putin. And frankly, it's just only so much a government can do. So And remember, we wanted to take steam out of the red hot housing market to improve the balance in the marketplace. And that's exactly what's happening.
Nobody's having fun putting 15 offers or being one of the 15 people putting offers on a home. That means 14 other people want to buy a home and they can't in that situation. I mean, that's not fun for anybody. And I've had a lot of conversations around that. So getting back to a more stabilized, normal environment, I think is great. And we'll see how this all plays out. I truly think that housing is going to continue to be sought after. You talked about immigration numbers and you talked about people having to live somewhere. So there's that. Employment is good, meaning that people are working. So when it comes to affordability, that's good. So there's a lot of momentum still, and we are at a low rate environment. Not as low it was, 2 months ago, 4 months ago, 6 months ago, 12 months ago, sure. But that was emergency rates for a particular reason that needed to be done. And for those that took advantage of it, great. And we probably stole some mortgages from the future on refinances for sure. And of course, purchases. But, I think there's still tons and tons of business out there, which is exciting, to say the least. I'm going to ask one more question and then we're going to wrap up. And this question is asking your advice about investments. Any advice on how to invest in this inflationary environment? Yeah, buy an apple and hold on to it for a week.
And then sell it to your neighbor, right? No, honestly, that is a long story and that we don't have time for. But that real assets and equities are inflation hedges. And so, what you haven't got invested in real estate, you can put in everything from art to I myself am investing in jewelry. Of course, I don't think there's a secondary market for it, but who cares? And it's there are always opportunities. Always.
Sherry bought those earrings last week for $100. They're worth $1,000 right now on eBay. So there you go. Yeah, and that's exactly right. I mean, cash, everybody knows this. Cash in an inflationary environment is not worth as much yesterday as it is today. Or sorry, it's worth less today. So yes, hard assets. She talked about art, jewelry, obviously real estate, some stocks. We definitely are good hedges, right? And that's just don't want to be sitting on cash. All right. Diamonds are forever. You got it, Phil.
I'm with you, Phil.
Yeah. Gold, diamonds. Yeah, absolutely. Well, Sherry, as usual, thanks so much. Great insights. We look forward to our next call. In the meantime, we do have a level up coming up May 26th. Please tune in with mental health advocate and best-selling author Alan Keller. It's going to be an awesome show with Gary. And until next time, thanks for tuning in. Thanks for all the questions. I think this must have been a record today. A lot of the questions that were asked were just repeat questions, so I didn't get to them. But this was a good session. Thanks so much, everyone. And until next time, take care. Bye-bye.
Bye-bye.